strategy, there are three benefits of it. The first component is the salary sacrifice strategy, like we talked about on those previous slides. The second one is the 0% tax rate in the pension phase versus 15% tax in the accumulation phase. If you think about that table that I showed you before about the investment structures with individual, joint, trust, company, and then superannuation, in that superannuation column where there's two columns, the accumulation and pension phase. In the pension phase, there was 0% tax. In the accumulation phase, there's 15% tax. So the second benefit of the transition to retirement strategy is that you're moving your money from accumulation phase to pension phase and getting the tax savings there. So say, for example, you had 500,000 in your super fund and it earned 5% income. That's $25,000. 15% of that is $3,750. So that's potentially the savings that you could get, the tax savings that you could get by moving your $500,000 into pension phase. Now, I did a podcast recently about this, and it was quite interesting because if you look at the amount of money in superannuation, there's about 1.2 trillion in superannuation in Australia. 63% of that is held by people over age 50. If you assume that only 10% of that money is in accumulation phase rather than pension phase, it's about $500 million of tax that is being paid that could be avoided by being in that pension phase. Good to check whether you are eligible to actually do that. It becomes, and the other benefit is, so the third fold benefit is that the income that you draw from your pension is either concessionally taxed when you're between 55 and 59 years of age, or it's totally tax-free when you turn 60. So that's the benefit of it. Other features are, well, not necessarily a feature, but if you don't have full access to the money, you can't commute it, so you can't pull out lump sums. And if you haven't satisfied a condition of release, and I think the next slides will talk about a condition of release, then the maximum that you can draw from your fund each year is 10% of the balance. So if you've got $100,000 in your super fund, the maximum amount you could draw each year is $10,000. So you've got to make that work as well. Just noticed we've got a few questions. I'll try to answer those. Does this only apply when you salary sacrifice? I'm not exactly sure. Oh, so does the transition to retirement strategy only apply when you salary sacrifice? No. So you don't need to salary sacrifice to get access to the other two benefits. The salary sacrifice adds an additional benefit onto it, but the two, you still, if salary sacrifice doesn't make sense because you're earning less than $37,000, then you still can get access to these two benefits, which still are advantageous. And just a thing I mentioned earlier about salary sacrificing and the level that you should salary sacrifice down to. We generally say that you don't salary sacrifice your income down below $37,000 because that's where the 15% tax rate kicks in. But there is, due to what the low income tax offset, which is it's $1,500 of benefit of tax offset, so tax that you get back if you earn less than $30,000. As you earn more than $30,000, that $1,500 drops back, so there is some benefit of actually salary sacrificing down to $30,000, and it's the difference is $400 in tax. So if you salary sacrifice down to $30,000 rather than $37,000, you save an additional $400 in tax. So generally, it's the rule that it's your salary sacrifice down to $37,000, but there is that $400 differential if you bring it back down to $30,000, just to get a little bit more detail there for you. Now here's an example of the salary. Example of the transition to retirement strategy. And this example, I'm just narrowing it down to where you're over age 60 and it's totally tax-free. It's slightly different when you're below age 60 because it's not as advantageous, but I don't think there's a slide. Yeah, there's not a slide, but it's slightly different when you're below age 60 because it's not as tax effective. Because this portion, say for example, Joe earns $120,000, he's salary sacrificing $39,200. That's because the other $10,800 is being contributed by his employer superannuation guarantee contributions. But then he takes out, he moves his superannuation money to pension phase and draws $23,700. He pays tax of 19, contributions tax of nearly 6,000. So his total tax is $25,000. But if you include the savings within his super by being in pension phase, if you add that together, then he's saving, another. It's the real difference between this and the salary sacrifice scenario is this $3,750 that he's saving by being in pension phase. So it's saving nearly $15,000 as opposed to I think $11,000 before. Just to answer another question here. How do you put your money into pension phase? Yeah, good question. It's just like another bank, like another superannuation account. Currently you would generally have a Christian superannuation accumulation fund. All you do is what you do is generally leave a small balance in your accumulation fund, and you open a pension account, and you just roll over all but this minimum balance over to that new account. So what you generally do is you end up with two accounts. You end up with a small balance in your accumulation fund and your larger amount in your pension account. So you end up with two accounts effectively. Thanks for the question, Paul. Colin, how do you change from accumulation phase to pension phase? Is there some documentation required? You both had the same question there. Hopefully that's answered your question as well. Just fire through another question if I haven't answered it sufficiently. So there's the scenario of the benefits of the transition to retirement strategy.